All right, well, to conclude, we have a fireside chat between Thomas Easton and Professor Robert Merton, I guess sans the fireside. Tom is the American finance editor of The Economist, and we appreciate him agreeing to moderate this session. Of course, Bob Merton really needs no introduction to this audience. My favorite paper of Bob's is a little-known working paper that he wrote in December 1970, immediately after receiving his PhD in economics from MIT and joining Sloan. The paper is entitled "A Dynamic General Equilibrium Model of the Asset Market and Its Application to the Pricing of the Capital Structure of the Firm." In this paper, Bob lays out the entire option pricing problem, comes very close to solving it. In fact, if you replace beta with the letter R, you have it. Says he can't solve it, but then goes on to say, if I could solve it, I could solve the following 10 other things like convertible bonds, risky debt, deposit insurance, etc. This paper became the basis for at least a half dozen PhD theses. I know mine was based on footnote 9 in the paper. Let's welcome Tom and Bob.
He is also on the imaginary board of directors of the imaginary fund that we're all investing in to solve cancer. So I'm quite honored to be here. I have never seen a conference this late in the day, and particularly not this late on a Friday, and particularly not this late on a Friday in summer that has a room that is so crowded. And I mean, clearly that's a consequence of three things. I mean, you're a very smart audience. You've had incredible speakers all today. And obviously, they're all here to hear Professor Merton. He won't recall when I first met him, but I just want to relay this anecdote. I had gone to spend the day at Harvard Business School. There is no school that is more promotional in the world than Harvard Business School. If you're a reporter, you go up there and they say things like, you know, you'll meet a professor and he'll go, you know, on background, I invented water, but don't spread it around. And the next one will say, air, it's mine. You don't have to make a big deal about that, you know. So I spent the whole day, you know, learning who created air and water and all this other stuff, you know, and I was just reeling at the end of the day, and I thought, this is just such crap, you know. And then I meet Professor Merton, and at the time, he was very interested in the Pension Guarantee Corporation and risks that weren't being understood. And it was probably just one of his millions of throw-off ideas that he has no recollection of today. But it was such an important idea that I actually gave it to a colleague, and through that idea and her writing about it, that The Economist thought, wow, she is smart, and they hired her. And it was actually just it was like footnote number 65 by Professor Merton. But anyway, at the end of the day, so at Harvard, they always debrief you, and they say, well, who impressed you? And I said, well, you know, not really. There was one unusual experience I had. I had this Professor Merton, and they went, oh, he's MIT. So I'm really delighted to be part of you know, MIT. After listening, I have a bunch of questions here, but actually following up on what you just said, two things. As far as the room is concerned, there's one thing that no man can possibly do, and that is control Professor Merton once he starts talking about something. So that's a challenge. I won't be able to do it. I'm sure that's why I got the job and no one from MIT did. But if you have a question, if you have a point, raise your hand right away. I don't want to save stuff to the end when we're on to a different subject. You know, if you want to challenge him, you're very smart, you have a nuance, please raise your hand. I will recognize you. The second thing is, I wasn't going to start this way, but you mentioned that there were so many problems that he saw in 1970, so many things that just needed something, a little nuance to be done, and that I was going to begin actually with in 1974, you know, he laid out all these principles on analyzing debt. It took to 1999 before the rest of us realized. So I know this puts you on the spot, but you know, in 20 years when we come back to have this conference, what is the Professor Merton idea that we're going to be discussing that we don't know about right now, but that you've been thinking about?
Oh, wow. Well, that's different. First of all, I appreciate...
Blame your colleague for this one.
I appreciate you all being here. I really wanted, I mean, I'm going to answer your question, but as you know, I'm going to go somewhere else.
Yeah, right. I am furniture.
No, but I thought on this occasion particularly, and given the talks that we've already heard, which, it's pretty impressive stuff, and, certainly we had the discussion of innovation, the wonderful panel, and then we had Andrew presenting this thing and solving these problems. And I wanted to kind of go back and talk a little bit about financial innovation, our industry, I mean ours in the very narrow sense, because, I guess motivated by 208, 209 in terms of public discussion, and all of us have lived with it, there's kind of this notion of a couple of things that I thought I was going to at least express my opinion on and be on record. And the first begins with this idea of the real sector versus the financial sector, sometimes called Main Street versus Wall Street, okay, as if there was a dichotomy. I know of no place that exists except in a couple of macroeconomics papers that don't describe the real world. They're inextricably connected. So this whole idea is you can separate them. I will mention, however, the Chinese Academy of Sciences put me on a committee, and when they sent me the English translation, it said, you're on the committee for the fictional economy. Now, you know where that came from. If the real economy, Main Street, is real, then what must be the financial economy if it's a dichotomy? Unreal. It went into Mandarin, and then when they translated it back from Mandarin to English, unreal translated back fictional. Anyway, so the first point to say is they are inexorably connected, and they ought to be viewed that way, and that the financial system is incredibly important to economic growth and development, and that we know Bob Solo's work on. We had talked about technology earlier, Douglas North. There's lots and lots of that. I shouldn't have to prove it. In fact, I want to talk about some of the, if you like, examples that we have to deal with. And what drives the change in financial systems to improve them? It's financial innovation. And what drives innovation? Finance science, I'll put that one first, technology, and economic need. Okay, so the first thing I wanted to say this afternoon is finance is really important to the world economy, and don't let anyone come this nonsense. The second thing on that issue is there's a confusion between complexity for the ultimate customer and complexity in the system. Somehow people are going around saying, all we need is a stock market and a bond market, everything will be fine, go back to the 1930s and it'll work great. And finally, there's the good old days, and I'll leave back to you, Tom, to manage this. But there's the good old days, and if you've lived long enough, and I've had the good fortune so far, you lived in those good old days. They weren't good old days. They were actually pretty crummy, and you wouldn't want to go back to them. And so what I'd like to talk a little bit about is this notion of financial innovations and its importance, and then talk about the future, if you would. Take me there.
I have a series of different question tranches. I realized when your colleague said something that it was just a feint in one direction. They really just want to hear what you want to talk about.
All right, fine. Well, let me just jump into it, because one of the things, I'll tee off the crisis, after all, that we've been talking about it now. The usual comparison I think you see almost always between 2008 and 2009 is with what? The Great Depression, the 1930s. I would at least make the case on the finance side that a more appropriate comparison is with the 1970s. The 1930s, there was no safety net. There was no technology. That's a long time ago. And nobody can compare the unemployment rates and so forth in the 1930s to what we had in 2008 and 2009, as scary as that was. So let me go to the 1970s, which was a world with safety nets and with many of the technologies, nothing like we have today, but a world not that similar. And let's talk about, first, what were the risks in that period? Well, I made a list here because I didn't want to waste time with it. I said that was a period of multidimensional explosion in risks of every kind. And I have a list in no particular order of importance. The fall of Bretton Woods, think about it. Bretton Woods goes from 1944 or 46, 30 years without thinking about currencies, and suddenly overnight they're all changing. A little bit of a shock. Then we had first oil crisis, 73, 74. We didn't know we had the number. We had another one in 79, okay? How about double-digit inflation in the United States we hadn't seen since the 19th century? And of course, double-digit interest rates, which we hadn't seen since that time. But what else did we have? High unemployment. It came to be known as stagflation. Just imagine, think of what policies have been followed, if in 2008, 2009, in addition to 9% or to 10% unemployment, we also had 10% inflation. What would the central banks have done? What would we have done? It's pretty scary. Stagflation, at least as far as I know, still 40 years later, economists don't have a solution for it. So let's hope it doesn't come back. Okay? Pretty scary stuff. The stock market fell in the US in an 18-month period by 50% in real terms. As to mortgage money, housing, we had Reg Q. Reg Q said the maximum you could pay on deposits was 4%. You could get 10% on US full faith and credit. Do you think there was a lot of money in banks for mortgages? That killed that market. And so I won't go on with all the lists, but when you look at that, I say that's a pretty comparable list to what we've seen. But the part I wanted to bring out was what happened in the 1970s, or in response in part. We had an extraordinary development of financial innovation. Enormous. Of course, the ones that Fisher Black and Myron and I greatly appreciated personally was the development of the first traded options market in April of '73, the CBOE. But what is that? That's just an insurance market for financial assets, puts and calls, okay? It's an insurance market. Why did it happen then? Because there was huge risks. The CME created, or at that time, the Merck created currency futures to respond to that. And then we had financial futures for stocks, interest rates, currencies, the whole 9 yards, commodities. What else happened during that period? Again, I've got a list here to move it along. I said, well, we had the option markets, NASDAQ, the first electronic exchange. ERISA, somebody mentioned the pension system for VC. ERISA was created in 1974, the modern pension system, okay? And what else? Oh, and another MIT, I mentioned obviously, I want to make it clear to this group in case there's any doubt. I love the University of Chicago, and it's been very good to me. But Fisher and Myron were at MIT, or at least in Cambridge. Fisher was hanging around MIT. Myron was at MIT when that work was done. Then they got hired to go to Chicago. Okay? So, they bought versus build. Okay? So let's just keep that record clear. But there was other MIT contributions here. TIAA-CREF in 1972 became the first major institution that instituted as a regular strategy international diversification in stocks, something we take for granted today. Who was on the trustee that pushed that? Paul Samuelson. Okay? What else happened in that period? We had May Day. None of you probably remember. You're a young group. But prior to May 1, 1975, we didn't have negotiated commissions. If I bought 100 shares of IBM, I paid a commission. If you bought 100,000 shares, you bought 1,000 times the commission, believe it or not. Coincidentally, we had the development of index funds. Now, in fairness to Mac McClown, Stagecoach Fund, 1970 was maybe the first one. But we all think of index funds, we think, of course, of Vanguard and Jack Bogle. That was started in '75. And if you just published this past 2 weeks, Jack Bogle came out saying, it was great to have Paul Samuelson as a friend because he's the one who gave me the courage to create Vanguard by putting up and putting that out there. So that's another MIT connection. And we got rid of eventually the deposit insurance, the ceiling on deposits. Money market funds were created. We had all kinds of floating rates. All kinds of this stuff happened. What else happened by the end of this? We created a national mortgage market. Now, we all take for granted that there's mortgage money all the time. Now, sometimes the credit is stiffer or not for people, but there's never been no mortgage money in the 35 or 40 years, whatever you want to date it from. Success has many, many parents, right? But we've always had mortgage money, and we still do, and we take that for granted. It was not true in the 1970s. So if you want to go back there, that's not a really fun place, I can tell you. All right, so we created all that. Now it's gone on, and I think they saw the golden age of quantitative things. I mean, the University of Chicago, give it its due, created the CRIS database. The first time we really had data to actually confront things. I think the most shocking thing that was discovered from that database was they reported the first simple thing. They took the average return. If you took every stock and just held it for 1926 to 1964, that average return was 9.3%. If you looked at trust departments and so forth at that time, I don't think there were very many of them that were coming close to that. It was a big shocker. So that's the 70s and innovation. These were innovations that today we take for granted are there. Now, and I don't want to be mentioning names, but there have been people who've said in this time that there hasn't been a financial innovation worth anything since the ATM. And of course, we know that's not a financial innovation, that's a technology processing, okay? So I was thinking about that, and I thought of one that you might want to keep in your pocket when somebody at polite cocktail parties brings this up. And that's the interest rate swap. Very simple in concept, right? Think of a Jimmy Stewart. I hope there's somebody in the audience who knows who Jimmy Stewart, when this reference is, 1941 is a Beautiful Life, that his kind of bank that we now wish we all had two kinds of customers, real customers. People that borrowed money for construction, for mortgage, for their business, who, and you could imagine in the 1970s with double-digit interest rates, okay, kind of liked fixed rates, so they knew what their cost was going to be for construction. That was their customer preference. And they had another class of customers called depositors. And what did they want? They wanted cash whenever they could get it at full value. Now, we know what that does. That creates an enormous interest rate mismatch in satisfying two important class of Main Street customers. Huge. If you look at the magnitude of it, interest rate risk in banks was far greater than credit risk. And they were always going insolvent. Every time rates went up, the only thing that kept us from wiping them out was the government's forbearance and so forth. It's just huge risk. Overnight, the interest rate swap and futures basically allowed us to get rid of that forever. And I think we'd all agree today it'd be very hard to predict what J.P. Morgan's reaction would be in terms of exposure if interest rates went up or down. We don't know, because it's so controllable. And this was a completely non-invasive, non-solution. And it operated perfectly well during the crisis. So I don't know why a former central bank governor wouldn't have thought of that as a useful innovation, but apparently maybe that was forgotten about. So those were those, and then you opened the door to this. So Tom and I had a long talk, and he told me what I should do, and I'm trying to. Okay. So let me give you another one, because this is another story you might want to think about. And this is true. In the 1990s, after the reunification of Germany, the city of Leipzig, which was in the east, wanted to start to really grow, and they wanted to develop electricity in Leipzig in a major way. And to do so, they needed to bring much more natural gas into the city, because that's how they produce electricity. And they were faced, now remember, this is an East German city that just became part of the West, that comes from a background. Leonid, you were mentioning your background. You know what background that was in terms of market economies and so forth, and you see it today anyway. And the problem was they had two choices for getting gas. They could get a gas from the Russians, and to do that, they had to build a pipeline all the way to Leipzig, which would have cost $300 million. Now, I know it doesn't sound like much. This is 20-odd years ago, okay? And the Russians' deal was X Deutschmarks per MCF gas, 15 years fixed, for a fixed contract. The alternative is they could have gotten gas from the West, the UK and Norway and so forth, much smaller pipeline, 50 million, but they would have suffered all the price volatility, huge. Now, even in our economy, that much price volatility would be a little tough for something basic. Could you imagine introducing and trying to explain to the people of Leipzig why their energy bills would be going like this with the markets, okay? Doesn't work. So a bank, one which at that time was actually AAA, if you believe it, a bank got wind of this and said, can we do something about this? And the answer was they could. They looked at it, they brought financial engineering in, and what they offered to Leipzig had to be very simple, because remember, this is not a sophisticated group. They said, okay, here's our deal to you. The Russians have offered you X Deutschmarks per MCF, 15 years. We'll offer you the following deal. Buy it in the West at market. Any time that market rate is above X, we'll fully compensate you for that. So you'll never pay more than X, but you may pay less than X. So even a city manager with no markets background said, which is better? Pay X for sure, or pay no more than X and sometimes less. Pretty easy decision. I call that pretty simple for the customer. It was incredibly complicated at that time, not so much today, what that bank had to do. There was no natural gas futures on market. There was a 5-year heating oil market. They had a currency problem, and they capped it so they had volatility. Well, I won't go through all the list. But in fact, it was very complicated for them, but that's what they do for a living. So complexity, there's nothing wrong with complexity if it solves the problem. And they did. Now, how were they able to offer a better deal than the Russians? Were the Russians highballing it? No. How were they able to do it? They had $250 million to split, the difference between the $300 million Russian pipeline and the $50 million Western pipeline. That's real economics. I believe that the split was the bank took $125 million gross. I mean, they have all their expenses and risk. And Leipzig got $125 million, so they were better off. Okay? Both parties better off. And by the way, the bank was a better credit than Russia, so they weren't taking a credit exposure either. But there's one more little spot to this story why I tell you about it. It was also green. As a result of pure risk transfer, financial engineering, nothing tangible, not just using contractual agreements and solving this problem, that big $300 million pipeline wasn't built. That's green. One more, since it was mentioned this morning, TVA. Comparable thing was TVA offered to buy calls and sell puts on electricity into the grid to anybody who was actually connected, not financial people, but people who were connected to the grid. And they put that offer out there. And as a result of that, this is again in a similar period of time, 20 years ago, as a result of that, they didn't have to build 2 nuclear power plants. They got enough electricity through the contracting of all these little mom and pops. They organized it. That was pure finance, organization, risk transfer. Nothing tangible, nothing of any other sort, okay? So I tell you those stories along with the 1970s stories because I want to make it clear that there's huge value in financial innovation and what it's done. And you don't want to go back, and you don't want to pretend, that we can do things with the back of the envelope. Now, that's about the past.
Yeah, so there are a couple issues in the present that, by the way,
You better interrupt whenever you can, because otherwise you're not going to.
So there are a couple issues that came up. Systemic risk. Did you want to talk about interconnectedness? I know that's a big issue.
In looking forward, because I told you history, but I felt compelled to tell you history when you've been told history for the last 8 years that would suggest nothing in this industry has done has created any value or anything important. And I want to just remind you how important it is.
We're going to build your self-esteem here, and now we're going to tell you what's going on.
Yes, all right, I understand. But I looking forward, I thought of it 3 areas that we talked about. One was systemic risk. And this is an area that's, of course, been of concern in financial stability, central banks, et cetera, for a long time. And what we've done there is to try to look at connectiveness between financial institutions and sovereigns. And this notion of connectiveness means vulnerability for systemic events. Doesn't mean it has to happen, but we know if there's a high degree of connectiveness, there's a risk of it. We've built tools to measure that, and I say, okay, well, so is others. What's different about them is they're built on finance principles, meaning they have risk embedded in the model, unlike macro models, which are certainty models of which you add an error term and then do Monte Carlo, and that's not the same thing. There is no insurance in a macro model because the macro model of certainty, insurance is redundant. Insurance, as we know, are options. They're nonlinear. They've got convexity. They're affected by volatility as well as levels. Those are in financial models. We built those into these models, and they are order of magnitude different contribution. They're not the whole answer to what we had in stability models that you'll find at the New York Fed or you'll find in the macro models. They don't build these in. So this is a special finance contribution, and it's a big order. The second thing is, you mentioned, some people have mentioned the structural model we know that you can think of debt and guarantees and all of that as being affected, as being measured as options. And in that context of looking at the risk transfer and all of that, we can actually use market data to look at how the degree of connectivity is changing, the degree of connectiveness, which we all know. What is the usual way it's done? If you're a central bank, you have position data, which the rest of us don't have. But what is it? It's position data. Positions is only one of many of the interconnectiveness, as we well know. Positions are not the only thing that link. We've seen how complex those linkages are, okay? What else do we have? Accounting data, very delayed. We use market data. Now, what's the advantage of market data? First of all, once you have the model set up, you can do it, you can run it every day. We know markets, imperfect as they are maybe, they do respond quickly. When things change, they change. In fact, you mentioned my debt model.
1974 paper.
74 paper, innovation, just for interrupt myself, Myron Fisher and I, it's always better to be lucky than smart, I say. Maybe lucky and smart's even better, but lucky is important. If we had written our paper in 1960, in our papers, it might have gotten published, and that's about it. But because it got published at the time it did, in fact, it came out in 1973, the same time, this is coincidence, as the CBOE was created, that innovation was implemented into markets completely within 2 years. Everybody.
How many years did it take? We were talking about how long
Right.
it took to be used in debt models.
Okay. So I said, gee, this innovation stuff is fun. You come up with a theoretical model, you work it all out, and 2 years from now, everybody is using it in practice. So I published this debt paper 1 year later. That was 1974. And it became an instant success in, what did you say, 1999?
1999.
Yeah, so only after 25 years.
I mean, we think of Wall Street being so on top of all sorts of innovation.
But I have an explanation for it. I mean, some prop desks and some hedge funds used it, and a firm called KMV did it.
But let me pause on the systemic risk. There has been so much discussion on systemic risk. Do you think we're in a better shape today than we were in 5 or 10 years ago? Do you think we understand it? Do you think the models, your model might be very good on it, but the models that are being used by the New York Fed and the others are actually capturing it? What sort of place do you think we are right now in terms of?
That's a very fair question, and I'm not quite sure how to answer it because there's two things going on, I mean, at least two. One of them is, as I mentioned, like interest rate swaps took all this risk out of the banking system, but what was one of the responses? A rational one, by the way. We could reduce capital ratios because there's less risk. And that's the endogeneity that makes the answer to your question a difficult one. Do we understand things better than we did? Absolutely. Do we have more markets and more information sources than we did? Absolutely. I'll just mention, because we won't get to it, all the forward-looking distributions versus backward-looking. Backward distributions is when you look at historical data, including yesterday, okay? Forward-looking, as you know, like the VIX, is you take market prices and you're getting the market's assessment looking forward. That's huge, okay? Just think driving down the turnpike, driving at 100 feet a second and looking in the rearview mirror. If things don't change, you're okay, but if they change, they do. So, it's a pretty important to have forward-looking information. Well, we now know, and Steve Ross just published a paper, it was Doug Breeden's work, that many people have published papers where you can essentially recover out of market prices a distribution, particularly in the interest rate markets where there's so many caps and floors, every maturity. You can basically create a complete states of the world distribution forwards in interest rate markets, for example. You don't mean it has to be right, but it's a wonderful tool. For example, when you look at the reaction when Ben Bernanke would say something, I'm going to keep rates lower for the next 3 years, and then you look how that distribution moved. Most of the time it moved the way you thought, but there was one time I remember it moved that the rates moved up when he said he was going to be stable for 3 more years, and that's kind of interesting. So we have much more information. We're going to have even more. We have more from the markets. I think we've learned a lot more. So that's on the plus side. On the minus side, we have, of course, more complexity. We have a more integrated global system. And the natural inclination is not to keep operating the same way we did. We usually take our safety benefits and translate a lot of that into other benefits, like being able to drive faster in worse weather or fly the planes out of here in worse weather, rather than use it to make our safety. So that's why I feel I can't really answer precisely where we are. But I do think we have the tools for sure, the data for sure, and the markets for sure that make us be able to do that better.
We were talking also about monetary policy because that has been such a dramatic effort, and that, whether that has diminished or actually increased risk, and whether we understand whether it's increased, what are the unintended consequences we might be seeing?
Well, probably the best example of that, I mean, again, this is MIT. I know Chicago's supposed to be the monetary school. Where did Ben Bernanke get his PhD? Where did Mario Draghi get his PhD? I actually had Mario Draghi as a student. If you wait around long enough, okay? Anyway, so these are all people I have enormous respect for. But what we know about monetary, one of the monetary policies, is we moved into the area of QE, where we not only, well, I'm not going to get into debate whether central banks can really control interest rates. If they can't, then we don't care. So let's assume they can, or at least somewhat, so that their policies have bite. That the policy decision to lower long-term rates, which you knew all the arguments for, was trying to improve consumption, investment, and all that, has other implications. One of the implications is it buried the pension industry because it raised pension liabilities to the moon. It put insurance companies, if not underwater, let us say, in very tough straits. But there's no question that the whole pension, certainly the public pension industry, was in the trillions of dollars underwater, in no small part because the liabilities went up, not just that their assets went down. Now, that's not usually, pensions and insurance companies normally, with the exception of AIG, but are not thought of as systemic because nobody can pull stuff out. But I don't understand that. Those of us trained in finance, we look at balance sheets. If you're $3.5 trillion underwater with a properly measured thing, I think that's a problem. That's systemic, okay? I mean, whether or not there's a run on it. And so I'm not saying it was a bad decision. I'm questioning whether we need to be able to have more integrated understanding of what policies are doing, fiscal, monetary, and stabilization, and that by doing the policy we did, we put pension in, and there's a secondary, and this is pure speculation, a secondary impact may have been that the baby boomers, and I see a few maybe out there, late stage baby boomers, you weren't early. The baby boomers are the ones that had the money and were spending. They may have thought they had enough for retirement until they saw what rates happened to them, and they realized that buy the same amount of income for retirement was going to cost them 40% more. What do you think might be your reaction? Maybe I better be saving more rather than consuming. So that sort of thing, more broadly, that's not a criticism, it's a description. I think we need to be able to much better integrate these three. And again, the finance tools are the ones that...
So let's talk about pensions, because this is one of your major interests, isn't it?
Yeah. Well, retirement, this is a global problem, as you're well aware. It's not just a US problem. We're aging. China's aging faster than we are, Korea faster than China, and so forth. Doesn't make us feel any better. It's just that we're all there. And that's, I just want to say the cause of that is partly the demographics of people getting older, the population. But the other one I just want to mention is good news. People are going to live longer. That's around the world. Nutrition's part of it, but they're going to live longer. That's the good news. The bad news is they're going to live longer in the sense they're going to have to fund longer retirement, and that's going to require changes. We had that coupled with, out of 2000, 2002, the employer plans, which are typically DB, okay, had a shock, and the corporate sector's just basically pulled it out of them. No one's starting new ones, and most of them are capping them, okay? So that was another shock to the system. And this is a global problem. But I will say to you the following. This is an engineering problem. It's not a science problem. That is to say, I really believe that we have the tools to solve this problem, to address it. But it's going to take everything we know, all the innovation we have, and it's going to have to go beyond investments. It's going to have to go to things like the reverse mortgage, which I hate the name. I like the Korean name, which is home pension. That doesn't sound better. And the reverse mortgage, which is on government, the only one doing it in the United States is the US government, needs to be greatly changed and revised to make it more efficient. And that, I'll tell you one problem with it. First, it's called a mortgage. People think, well, then banks must be the holders, should be the holders of these. I don't care who distributes it, but the holders of the risk. And the answer is no, that's not what it is. But I won't go into that. It's a teaser. We have to change the way it's financed, but it's all doable with today's things. But we're going to have to do that. We're going to have to get the annuities right, because I'm talking about working and middle-class people, not this audience, okay? And that's part of a problem in our industry. People do introspection, and they think, oh, the way I think what I'm thinking about is the way people are. And let me say to you, working middle-class people do not use their retirement accounts as a saving account. It's to provide for income and retirement sufficient to live.
So why do you, it is interesting that we have all these schemes to help you invest and save, and yet none of them are really structured around retirement, you know, in terms of the distribution of all the money that you're collecting. Why does the annuity industry kind of, I think it was in other countries, it's far more developed than it is in the United States. You must have thought about how it can be developed better here and what can be done.
I don't know if it's much better. You know, UK just used to have mandatory annuities, so they just got rid of that. So, but the answer, I think, is in part that, you know, we had financing of retirement comes from three sources in every system at every time. It comes from the government, like our Social Security. It comes from employer plans, and it comes from personal saving, the family. And various mixes of those at time and space have been a solution. I already mentioned the employer plans. We've had a shock there. The employer plans are providing fewer benefits than they did. You don't need to do a survey on that. That's why they get out of the DBs, which were expensive. I don't think many people think Social Security is going to be raised, okay? So what does that leave?
Well, it just seems that would be a perfect area for financial engineering, in that,
Yeah.
you know, the law of large numbers would actually provide some, you don't know if you're going to live 5 years or 20 years or 30, but some sort of.
But we're going to have to do that. But what I'm trying to say to you is that we had a structure which had annuities. It was called the DB plan. And people didn't call it that.
Because it was done through
It was done all the time. No, that's what happens when you have a shock to the system. You change the institutions. It's solvable. It's just going to take some time to get it organized.
Do you see the seeds of the solution already emerging?
I think we're getting there. I've been at this in terms of implementation about 11 years, 12 years now. So, you know, it's like that piece, you know, sometimes you have to be patient. And as you can understand, I'm getting a little nervous about being patient too long because it's been a long time. But no, I think we are getting there because even the US government is beginning to realize that we're measuring risk wrong in the DC plans. I'll just leave you with that. What do we have by law? What do I have to send to you if you have a 401k or anything? I have to send you your NAV. So you're 61. I have you in long-dated tips that will lock in your income well into your retirement. But I send you what? your NAV. Interest rates go up 60 basis points on the long term. And they see their NAV fall by 18%, and they go berserk. I'm 61, I've lost 18% of my retirement. Now, of course, the reality is their income hasn't changed. I only give you this as a fast pass to show you how screwed up, excuse my French, okay, we are in this particular domain. We're measuring the wrong variable. We measure risk in terms of value when it should be in terms of income. And therefore, everything that flows from that, including all the regulation, gets messed up. And this is not trivial. Reverse it. What if I put you in the gold standard of safety as we would measure it? Treasury bills. If you had $1 million 9 years ago, what would you get in a certificate of deposit in a bank? The safest, simplest thing. 4%, 5%? What do you get today? 10 basis points, 5%? So I used to get 40 or 50,000 income. Now I'm getting $1,000 a year. And you say, congratulate me, I put you in the safest asset out there. Your $1 million is still worth $1 million despite all the disruption. And the answer is they can't live. So that's my fastest example to say these are things we need to fix. But every one of these things is fixable, and I believe will be fixed because of need. And it's a wonderful opportunity for this audience, those people in the industry, to help it to come along. The government looking for ways to try to measure income to do this. They are looking for ways. So in that sense, I'm optimistic.
Do we have any former students of Professor Merton in the audience? Oh my God. Do you have any questions that you were too terrified to ask him when he could fail you, but now he cannot fail you and you would like to ask today?
You got 4 seconds.
Oh, we can go over a little, George. Yeah. Is he so intimidating a person? I know there's a reason that they put me on
I think
stage.
it's Friday, 5:20. The last
No. He is running off the stage, but we're going to hold him. There are two questions,
I have a
I
question.
think, here.
I'm not a former student. I just wish I was. So it was said that when Black and Scholes first presented their results in Cambridge, you overslept. And my question is, why did you oversleep?
Well, let's get the story straight. It was symmetric. This was Wells Fargo. Mac McClown had a capital markets conference at MIT in 1970. And it's true, I overslept for their presentation, but they weren't at mine. Okay. No conscious decision. It was just, it happened. And it's a good story.
Did you, have you all heard the story? Professor Merton just told it to me about the huge royalty he made from the first computer to calculate options on the trading pit. What happened?
Oh, well, I'm sure many of you have heard this. When I mentioned, by 1975, everybody on the floors of all the exchanges, were using the same model. And because you couldn't be electronically hooked up or anything, and it was before PCs, you had a handheld calculator made by Texas Instruments, and they put a little thing in it that would allow you to get the option price and the hedge ratio so you could trade one option against another and hedge your position on the floor. And everybody was using this. So Myron Scholes, if those who know Myron, he's a character. He calls up Texas Instruments. He says, don't you think we should get some royalty from this? And they told us, no, because of course you put it in the public domain, and we knew that, and that's what we always did. Then he says, can we get a free calculator? And he said, no. And that's true.
Well, thank you very, very much. Pricing medical innovation. So thank you very much.
I hate to do it. I mean, I'm prepared to go right to the Ranger game, but but thank you guys.
Okay.
Thank you.